conversation. Today we have Dominic Micheli and Nick Flaherty from Nova Street Partners. They are a private credit firm based in Dallas. And I thought I should invite them on this because they do some really unique things. So Dom and Nick, welcome. Please tell us a little bit about yourselves, your background, as well as your firm.
Yeah, thanks for having us, Rocky. Nova Street Partners is a small private credit firm that started spring of 2024. We focus on doing investments between $5 and $25 million to provide growth capital in the form of debt. We're industry agnostic, small team, like to think that we're flexible in what we can do, and that's a differentiator with us between kind of other firms and banks that might have a tighter box of what they can underwrite. My personal background is I ran a residential mortgage whole loan trading fund for 10 years with our other partner. Nova Street Partners is three of us that founded the company. With that fund winding down, we have capital on balance sheet to invest. So there's no committees, credit teams that need to underwrite. It's just the three of us trying to decide where we want to invest and help grow other companies.
My background was at Goldman in the private credit group. Was there for a number of years before jumping over and partnering with Nick and one other partner to form Nova. A lot of the same rules apply. We try to maintain a lot of flexibility at Nova for our borrowers. We deploy really flexibly across any industry, really kind of excluding real estate and oil and gas. Just all the things Nick said are true. We try to be pretty creative with what we can structure and offer borrowers to be the best fit possible.
So if I could go back to the differentiation point that Nick was trying to make, you guys are firmly in the space where there are lots of SBICs. Your transaction size, the type of credits you look at, but you guys are a little bit different. So why don't we kind of drill into that? How you differentiate yourselves from SBICs in terms of the type of transactions you can do, the way you structure the deals, your return requirements, et cetera?
Yeah, our mandate is just to provide debt. So we won't play in the equity space like an SBIC would. And so we're really looking to underwrite the downside case in a company to make sure that we're comfortable that we feel while the company is trying to grow and has the upside, that we're not really putting as much importance as the equity upside as an SBIC would. And so we're really looking for solid debt risk for safer companies that have some base that they've grown that we can underwrite the cash kind of projections and EBITDA going forward.
And it's primarily, your compensation is primarily interest rate, so to speak. You do not, most of the SBICs end up taking warrants or they have some equity compensation. I'm assuming that that's not mandatory for the way you structure the transactions.
That's correct. We don't need the equity kickers, and we don't need significant dilutive equity. That's why I'd say, honestly, we don't really compete against SBICs very much. SBICs, we typically see them on, independent sponsor transactions and similar where leverage is much greater. And that means that they need, 20, 30% sort of equity dilution. And again, we're just not going to participate in things like that. Our focus is on finding good debt risk where, there's significant downside protections. And while we may, underwrite the equity upside, we're not depending on it.
So that kind of leads into my next question quite appropriately. When you say good debt risk, what is a good debt risk? What is the right ideal credit for you guys?
So I think that's one of the best things about our platform and how flexible our capital is. There isn't a perfect middle of the fairway deal for us. We can do anything from senior debt to mezz debt, as long as, again, the company is US based and isn't really in the real estate or oil and gas industries. So like, what are some themes of good investments that we've seen? That would be, things that have good debt protections, either through hard kind of collateral, whether it be real estate or asset based, or good cash flow dynamics, good EBITDA profile, good, strong kind of, record or growth trajectory. And typically those companies have some reason that a traditional bank, like a commercial bank, would have a hard time underwriting them, or just can't understand something. So we can spend a little bit more time on it, get comfortable with it, and deploy dollars.
Well, a lot of times when we approach borrowers, one of the common themes is, well, we know XYZ banks or we know XYZ firm, and we are comfortable with that fact because we just know them. There's a so-called relationship. Now, being a lender, I know that relationships are important, but they do not always drive the credit decisions. How do you guys get over that particular pushback that come from some of the lenders? And then some of the examples where you did not have relationships, but you guys ended up delivering that their relationship lenders could not deliver, because you guys do something that is pretty unique compared to a lot of other lenders.
I think the biggest thing there is we try to be very quick and thorough in a first round of responses. Any sort of introduction, we're not very often going to find something that's an immediate no. We'd love to look into the situation, understand the history, the backstory, where the company is going, do a first pass at whatever financials are off the shelf, and provide some immediate feedback. And hopefully through that kind of upfront effort and thoroughness that we're willing to do without knowing if the deal is going to come to us or not, we try to build trust and confidence that we're looking at this in a serious manner, and that we're not going to kind of put the hook in, seem interested, and then back out a later date. If it's not for us, we'll tell you right away, but that's rarely the case. And we love to kind of dig in and really understand the companies.
So on that point, giving a reliable feedback, tell us a little bit about your process, as to the process you go through to make sure that if you do put out a term sheet, something that you can back and something that borrowers can rely on. How do you go about evaluating the deal? What steps it goes through? Obviously, you are three partners and you're deciding it, but how does a person who doesn't know you can rely on the term sheets you guys provide?
Mm-hmm. Yeah, and obviously, like, it's hard to say just trust us, like, we aren't parties that are just going to back down from a term sheet. But I think as parties have given us a chance, and even individuals like yourself, like, people find that when a deal initially comes to us, we'll digest every file that's sent along with it, any presentation, we'll read all of it, and generally speaking, we'll ask engaged questions. We'll make sure we have follow-ups. We'll get on the phone with brokers, the management team, really understand the transaction that we're underwriting and what the need for the capital is. From there, if we'll then let them know at that point, hey, how interested are we in the investment? And to the extent we're very interested, we'll keep diving in deeper, and we'll get to a point where, again, we deliver terms. We'll deliver a term sheet that really we've done enough work on at that point that we can stand by it. And that term sheet, more than anything else, will lay out what extra diligence we'll need to do. We'll always let the company know, hey, is there going to be a really detailed underwriting process with a bunch of additional file requests? Are we going to be getting any third parties involved to diligence anything, whether it be an appraisal, any sort of quality of revenue, quality of expenses, or QOV requirements? And we basically get on the exact same page of how do we think about the business? And if it's the correct way to think about it, we don't change terms, we don't retrade, we don't back away from deals that we've signed up. That's just not the relationship that we want with the company, and it's not the reputation we want to build in the market.
Just to add to that, if we get to the term sheet stage, we have high confidence that we'd like to move forward. And as long as nothing extremely surprising comes up that wasn't available during the first round of diligence, we're going to do everything we can to become comfortable with the transaction.
Well, market continues to be quite fragmented. I mean, there are lots of companies out there. that you can finance. It's not that easy to find them, and different firms have different ways of getting to market. How do you guys go to market? Now, we send you some deals which are relevant for you, but besides us, what is kind of the main way that you end up sourcing transactions?
Yeah, I think there's a few ways. We'd love for all of our deals to come from CAPX. We'll continue
We would love to send you
work
more.
with you. Yeah.
Yeah.
Other avenues are bankers that have relationships with the clients that know us, kind of know how sincere and diligent we are in our transactions, that will bring deals for us to look at. It helps when we've dealt with those bankers before. They know us, have our reputation, and kind of back us up. There's other personal relationships. One of our partners has a few operating companies, and a lot of experience that way. So if there's introductions there, also through the Dallas area, through our network. But yeah, we try to cast a wide net to look at any and every type of deal to see what fits for us, since we have such a wide mandate on what we can do.
Yeah, we like to try and help you expand your funnel beyond Dallas metro area. So, I mean, we are a nationwide platform, so hopefully we can find deals for you all across the country. Let's go back to where the market is today. There are lots of uncertainties in the market in the way that, deals that come to market, the deals, how they get executed, what you discover in the diligence phase, as well as uncertainty related to who needs capital today, private equity firms, independent companies. What are some of the trends that you are seeing in terms of the deal flow and your interaction with the borrowers?
I would say we see a really healthy mix of both sponsored and non-sponsored transactions. I think recently we've probably seen a trend towards more on the sponsored space. And with that, generally comes a little bit of, more cleaned up kind of like financials and, cleaned up underwriting items.
Yeah, it seems like at least recently here, there's been a lot of uncertainty. Maybe people putting things on hold because of the election and the rate environment. But I agree. It seems like if the company is sponsor backed, we see kind of things have been thought through a little more, and there's a go to market strategy. Let's get this done. We don't. I wouldn't say have to have a sponsored deal. We're willing to work with kind of owners and founders that have spent thoughtful time preparing financials, their information that we can work with. So we're hoping things thaw out a little bit here, and we can work through the uncertainty.
I feel like there are typically two types of transactions that we'll see. Like, one is that cleaned up sponsor transaction where they have, really good financial models in place. They have good reported financials. And then the second is like, maybe, a non-sponsored company or otherwise where they don't have as clean of financials. Mm-hmm. They don't have as clean as reporting metrics of ways to track the business. And we like looking at both. And honestly, in the latter case, we feel like we can add a little bit of value by providing our own output and our own expertise in some scenarios, kind of, looking at it as like a partner where, a lot of private credit players don't share their outputs with companies or their tracking models or things like that. But we generally do, and we try to just be helpful in providing those things.
One more thing I wanted to understand from you guys, and I'm not sure it's quite relevant because you guys are a relatively new firm, but markets have evolved quite a bit, credit markets in the last, 15 years. There are many more players now. 15 years ago, you'd be probably dealing more with a syndication desk at a bank. They would send you paper, you write book and you figure it out and move forward. Today, you are dealing directly with the borrowers. You might be dealing directly with the sponsors. You might be dealing with a bank that wants to do the first out piece and you end up doing the last out piece. So there are lots of moving pieces in the transaction processes. Do you guys use any digital tools that kind of help you manage this a little bit better? Or you wish that there was something that kind of helped you coordinate all these different pieces in a much more effective manner? Now, the reason I said it might not be that applicable to you is because you guys are born in this environment. So probably what was before is not that relevant, but just to kind of understand if you have some thoughts on that.
I think what CAPX provides is kind of a solution to that. Because the market we feel is so fragmented in this small to medium size
Yeah.
enterprises that there's so many companies. There's no way we could cast that wide of a net to find all of them. And so I think what you provide to be able to kind of filter and funnel those companies to us is incredibly valuable. And I think what we try to kind of solve in return is someone that can look quickly through opportunities and tell you whether or not it would be a good fit for us.
There are both more and more private credit players out there,
Yeah.
and there are more companies looking for capital in the current environment. And, you know, we can go and beat the bushes all we want, and we're never going to find, like, you know, all those people looking for capital, and they're never going to find us. So CAPX really does solve that problem. It you know, gets everybody in one, like, you know, environment, and, you know, allows a lot of connections, which is really, really great. Like, tool is perfect for it.
So as a potential borrower user gets on CAPX and they're trying to tell their story to you, what should they think about when they are trying to reach out to somebody like you? What is kind of mindset they need to have to communicate the right information to you? How they should pitch, you know, their company to you? What are you looking for, and how they can present that to you?
So the first thing that I would think about is that we're a smaller platform, and by virtue of that, you know, you're talking to the people that are effectively going to be making the investment decisions. You're talking to, there isn't a larger committee that we're going to bring deals back to. So with that, you know, you're talking to the decision makers. We'd ask that people be as transparent as possible, that they provide, you know, what are the strengths and risks of the businesses, like provide good background on what the business is, and just help us dig in, you know, as deeply as we need to fully understand things. I think that gets to a lot of your previous points too, on, you know, if teams do that, we'll be able to deliver them a term sheet if we're interested that we feel really comfortable standing by. You know, we would just, you know, hope that they provide good information through a presentation, good information on a data room, and just try not to, you know, really hide anything throughout the diligence process.
Which you'll discover anyway if that happens.
Yeah,
and
ideally.
I think, yeah, like John said, the more data, the better. We're not afraid to roll our sleeves up and digest anything that's provided. And then again, I think sometimes what we see is, and it's understandable, is that the founders or the operators of the company are so bullish on the upside, which we love and we want to understand. But I would hope and that they'd be able to explain what they see as the risks for their company and how they get comfortable with them, because that's really what we need to understand. And if they can help us understand that, then we get more comfortable with the process and the underwriting, and that gets us closer to the finish line.
Well, when I interact with, you know, CFOs and borrowers, what I tell them is that most of the time lenders are, you know, looking at the rearview mirror. They want to know that picture first before you tell them that your company is going to grow 3 times, you know. So their focus should be on what has happened and why it has happened and how they can prevent negative things from happening again. That's kind of the main thing. And lastly, guys, for firms that might not have ever dealt with private credit firms, especially firms like yours, their reference is always a bank. What they could be misunderstanding, or what could be in their perception that could be incorrect? I mean, how should they look at a firm like Noah Street Partners?
Yeah, I think the biggest difference between us and a bank, and then we touched on this a little bit, but is that how small and nimble we are, and that there are no committees. It doesn't get passed off from a due diligence team to a credit committee to an investment committee. Like it's you can have a casual conversation with us and explain where you've been, where you're going, and how you're going to get there. And so I think that's the biggest difference between us and a bank, is that if you've got some big red flag, tell us. Let's wrap our arms around it, figure out how to like box that potential risk or prior risk in, understand it, and then we can get over it. Whereas if sometimes something like that happens and you're trying to present to a bank for a loan, they're just gonna be like, why would I don't want to have to go explain my boss what happened or why this could happen. It's everybody's right here in the same spot looking to understand your business and why you're going to be successful.
And further on that, like we'll try to hear out any given investment. We'll always try to take a little bit of a deeper look. We don't have hard stops like banks do, where if it doesn't fit in, a nice little box, then then they won't do the deal. We can we have a lot of flexibility in what we can invest in. So we'll always hear out the story. I think per, your point, we'll want to understand the historical period, understand exactly what happened, roll up our sleeves, really, get to the bottom of, any story that there is. And then I'd say more than a bank necessarily, we try to underwrite what will happen as well. We try to understand what the equity case is. We try to understand, the equity's perspective and, exactly what they've put in place to succeed, which allows us just to get a little bit more creative, a little bit more flexible with our solutions.
Makes sense. Well, guys, thank you so much. Nick, Dom, thanks for your time. Thanks for all the input. Looking forward to finding more deals for you guys. And hopefully we can work more together this year.
Great, thanks.
Absolutely, thank you.